Hi guys, so we're on chapter 7. Do it right once with irrevocable life insurance trusts. So chapter 7. Do it right once with irrevocable life insurance trusts. Avoiding danger is no safer in the long run than outright exposure. Life is either a daring adventure or nothing. Helen Keller. Case study 15, Donna. Donna was in a dilemma. She knew that if she held her $500,000 insurance policy in her name, it would be included in her taxable estate when she died. But she also knew that she could not give the policy to her daughter outright because she was not very good with money and would not pay the premiums. And she learned about an irrevocable life insurance trust. Anybody watching this and your parents have opportunity for you and there's some sort of money, you need to be smart with your money too. Your dad's a fucking investor. Your dad's good with money. He has multiple properties. You need to learn those properties. You need to learn the laws better than him, man. You need to become his trustee. You need to become, my other Thea has her own like at home. She has like her own salon studio. She can be making her house a fucking home-based business. She could be taxing her corporation for rent, and getting a deduction for that, creating an income for her. And I told my other Thea, who's like pretty much, they're like best friends, they're like twins, but they're not really twins. But she's there with her all the time, I'm like, you could be helping her, man. You could be being the brains of the operation, You could be her accountant. So by creating a trust to hold a life insurance policy during your life, so she just created a trust to keep her life insurance policy. By creating a trust to hold a life insurance policy during your life insurance proceeds can be removed from your estate when you pass on. So it's separate. So you made it separate. So she knew that if she held her $500,000 insurance policy in her name, it would be included in her tax estate when she died. So she pretty much made like a small corporation, a small trust that she pretty much, it's not in her name no more, so it's protected when she dies. But she also knew that she could not by creating a trust to hold the life insurance policy during your life insurance proceeds can be removed from your estate when you pass on. This can be significant if your estate exceeds $675,000, or if the insurance proceeds put your estate over $675,000 and into the taxable reach of the federal government. On the other hand, Donna had to wrestle with the issue of who would be the beneficiary of the policy. Her daughter had married an abusive, spendthrift alcoholic. Donna knew that if he got his hands on the money, it would be gone in an instant, but for the trust to work, it had to be irrevocable, meaning she could not change the beneficiaries. Oh, so she couldn't. So you have to really pick somebody. You can't change it. So let's go back to Helen Keller. Avoiding danger is no safer in the long run than outright exposure. Life is either a daring adventure or nothing. Avoiding danger is no safer in the long run. So you just have to live your life but be protected at the same time. By using key points, by using a life insurance trust, the decedent's estate is not taxed on the proceeds paid. In addition, the beneficiary is not assessed any federal income taxes on the proceeds received. A life insurance trust must be irrevocable. Retaining the right to revoke or alter the trust results in the proceeds being included in tax in your estate. Okay, so being the right to revoke or alter the trust results in the proceeds being included in tax in your estate. So once you put it in the trust and you give it to that one person, you're not really responsible for it anymore now. Not that it's being protected by the trust, but it's not yours anymore now. It's like in between now. because when you're alive and then you die, the trust must be established 3 years prior to your death, or again, the proceeds are included. So you got to do it now. You must have the trust must be established 3 years prior or your death. Okay, the trust must be established 3 years prior. The trust must be established 3 years prior or your death. Or, again, the proceeds are included. So the trust must be established 3 years prior or your death. Or, again, the proceeds are included in taxing your estate. You must have an independent adult or institution serve as trustee. You cannot serve as trustee. So you can't be a trustee of the an irrevocable life insurance trust. Let's see what this is called. Yeah, an irrevocable. Like, you can't take it away. An irrevocable life insurance trust is a separate legal entity specifically created to own life insurance and thus reduce federal estate taxes. So I'm saying it's not yours no more. It's separate. This is accomplished because the trust, a distinct entity, owns the policy, so the proceeds are not part of your estate. Of course, instead of going to the trouble of setting up a trust, the life insurance policy could be transferred to someone else. But Donna did not like that idea. She wanted as much legal control as possible over the policy. First, to be certain that the premiums were paid. And second, the thought of her daughter's abusive mate owning a life insurance policy on her life scared her. People had killed for less. For real, fuck that guy. Fuck. Crazy, man. And this is probably just a simple woman that went to work every day. Worked and worked and worked. Like, you know, I have tias like that, you know? My dad is like that. You know, he's been working for the county for years, but I don't think he kind of made his own mistakes. He could be in this book. He kind of, instead of taking in like a retirement plan, he kind of banked on having income properties, but he made a mistake. He made mistakes. Of course, instead of going to the trouble of setting up a trust, the life insurance policy could be transferred to someone else. Yeah, because if she gives it to her daughter's not going to pay the premiums. But Donna did not like that idea. She wanted as much legal control as possible over the policy. First, to be certain that the premiums were paid. Because you got to put into it, right? And second, I mean, whatever you're putting into it is what they're saving for you. And second, the thought of her daughter's abusive mate owning a life insurance policy. That's what I'm saying. This is a woman that went to work every day. Couldn't really be there for her kids, you know. Was a single mom, so her daughter doesn't have no fucking dad, you know. So she made stupid decisions, man. And second, the thought of her daughter's abusive mate owning a life insurance policy on her life scared her. People had killed for less. So yeah, what's happening is, like, if she were to give it up to them, then they're like, oh fuck, but it's only good until, like, only once my mom dies. And so damn, what the fuck are we waiting for? We need money now. Let's just get rid of her. Instead, Donna chose her most trusted friend to be the trustee. As prearranged, she gave her friend $5,000 a year as a tax-free gift. And her friend turned around and used the $5,000 to pay the annual premium on the policy. Donna knew that if she made the payments directly to the insurance company, the IRS would contend that, just as if she were the trustee of the trust, she was maintaining an incident of ownership over the policy such that it could be taxed in her estate. So like millions of other Americans, she made the gift to her friend, who then paid the premiums, an indirect payment plan acceptable. Okay, so she gave a gift to her friend. Her friend used that gift. So Donna, I don't know, personally or in a corporation, she was able to tax that gift. She was able to get a deduction from that gift. And her friend, who was the trustee of a trustee to that to her irrevocable life insurance trust. Instead, Donna chose her most trusted friend to be the trustee. As prearranged, she gave her friend $5,000 a year as a tax-free gift, and her friend turned around and used the $5,000 to pay the annual premium on the policy. Donna knew that if she made the payments directly to the insurance company, the IRS would contend that, Just as if she were the trustee of the trust, she was maintaining an incident of ownership over the policy such that it could be taxed in her estate. Yeah, so she's she's paying it as if she still owns it. So the IRS is gonna be like, no, we're gonna tax that estate. It can't be yours no more. Once you put it in a trust, it's not yours no more. It was an indirect payment plan acceptable to the IRS because it was made by the trustee. Donna continued to worry over the naming of a beneficiary. Donna continued to worry over the naming of a beneficiary until the last minute. And that's the fucked up thing, man. When you have a relationship with somebody, it's hard to get rid of them, man. You know what I'm saying? Like, especially if they're toxic and they're dangerous, you can't get rid of those fucking people, man. They're no good, man. But you don't see no better for yourself, man. Like right now, I'm thinking she should talk to her daughter and say, look at this money I'm leaving behind. Don't you want to fucking get it together? Fuck this guy. Even get in his fucking head. Fucking retard. Donna continued to worry over the naming of a beneficiary until the last minute. She knew once the trust was settled and final, she could not change the beneficiary. Neither could she ever borrow against it, cash it in, or even select a payment option. So she to take any of those steps would also demonstrate an incident of ownership, resulting in taxability of the proceeds. So she couldn't borrow against it, she couldn't cash it in, or even select the way it's being spent, payment option. In the end, Donna decided that she would simply have to outlive the alcoholic husband and named her daughter the beneficiary. She would simply have to outlive the alcoholic husband and named her daughter the beneficiary. Donna did not tell her daughter about all this for the fear that the husband would find out. She could only hope that her daughter would someday do the right thing and that any insurance monies would assist her in the future. Fucking stupid. Conclusion: an irrevocable life insurance trust offers a means for the tax-free handling of life insurance proceeds, but being irrevocable, there is a loss of control. Yeah, because once you put in that trust, it's the beneficiaries now. To avoid the IRS trying to tax the proceeds, you must have no incident of ownership of the trust. To avoid the IRS trying to tax the proceeds, you must have no incident of ownership. You cannot be trustee, change beneficiaries, or cash in the policy. You must select your beneficiaries carefully, or if later dissatisfied with your selection, you may stop making the indirect premium payments so that the policy lapses and then form another insurance trust with new beneficiary. Okay, you must select your beneficiaries carefully, or if later dissatisfied with your selection, you may stop making the indirect premium payment so right here he's saying that you can choose another beneficiary, you just have to make a new trust. Or if later dissatisfied with your selection, you may stop making the indirect premium payment, meaning the gift you give to your trustee and them paying it. So they stop and the policy lapses, so you start owing money, and then form another insurance trust with new beneficiaries. So it sounds like there's some way out of it. So anyway, that's the end of section 5, chapter 7.